Guess we're all good to go. Thank you very much for joining me today, everybody. Happy Friday. This is Ilian Yotov, founder of allthingsforex.com and the host of the popular daily All Things Forex broadcast, which hopefully next week is going to become the All Things Forex Trading Room. And you're welcome to check it out. I know I promised last Friday that this week will be up and running, but the development is taking forever. And you know how it is with technology. So for those of you who are impatient to find out about the new program, a little bit more patience, a few more days. Hopefully we'll be up and running. The webinar, live webinar platform that we're going to use for the trading room is for some reason not being compatible with my current website. So we're working to find a way around that. So once again, thank you very much for joining me. Thank you to our friends at fx3.com for hosting this series of webinars. You're welcome to check out my website, allthingsforex.com, as well as my book, The Quarters Theory, The Revolutionary New Foreign Currencies Trading Method. Available everywhere books are sold, but my book is not what we're going to talk about in the program today. Today we're going to once again prepare for the upcoming trading week, which is going to be very interesting with two currencies in particular, actually three of them, coming to the forefront and stealing the spotlight. The first one is going to be the euro, with a couple of important economic events coming next week, which will provide more clues as to how the Eurozone is doing as far as economic conditions are concerned. And both of them, by the way, are in the list of the top 10 events, both of the events from the Eurozone, both of them not expected to instill much confidence in the state of the current economic conditions in the Euro area. Of course, the reason why we're also going to pay close attention to the Eurozone economic data next week is because the week after next week, we're going to see the European Central Bank's interest rate and monetary policy announcement on May the 2nd, Thursday after next Thursday. So traders next week are definitely going to gauge economic conditions in the Euro area, and dependent on that, they will also price in expectations as to whether or not the European Central Bank is going to be forced into doing more easing, possibly announcing it as early as their next meeting on May the 2nd. In my opinion, if the Eurozone economic data next week shows more weakness, which that's what the consensus forecasts are pointing to, the euro could be put under pressure. That also, if that's coupled with more risk aversion and weakness in the equity markets around the world, we could have the formula for further euro weakness and possible push into the $20s. But before we talk about in more details about the euro, let me mention what the other two currencies that are going to be in a spotlight next week are going to be. That will be the British pound and the Japanese yen. Of course, many of you know next week the Bank of Japan is going to announce their interest rate decision late Thursday night of next week. And earlier that night, on Thursday night as well, we're going to see the main gauge of inflation in Japan. Because of these two events, obviously, the Japanese yen will stay in the spotlight. It was in a spotlight this week, as we discussed last Friday. And the other very interesting currency that at least I will be paying very close attention to, especially next Thursday, is going to be the British pound, as I think the big event next week is the UK GDP report, because it will either confirm or deny the expectations that there may be an unprecedented triple-dip recession in the United Kingdom. Was there another quarter of a contraction in the first quarter of 2013? So, without any further ado, let's go ahead and start with the list of top 10 events. The first one is going to kickstart the trading week with the U.S. existing home sales. Many of you know this is the main gauge of the condition of the U.S. housing market. And Earlier this week, we saw housing starts being okay, a little bit above the expectations, and that's probably what we're going to see, a little bit more existing home sales in the month of March. The forecast number by Reuters is 5.01 million, so a little bit above 5 million compared with 4.98 million in a previous month. Now, in recent months and weeks, those of you who listen to this program regularly, remember that I've talked and brought your attention to some of the surprisingly negative economic reports that were starting to come from the United States. Weakness in some of the indexes there, the ISM indexes, and also unexpected spike in jobless claims that was sort of offset by the last couple of weeks. Jobless claims have returned back to normal in a 350,000 area after the unexpected spike, but we still had a very dismal non-farm payrolls report with much lesser job creation than expected. Unemployment rate also inched a little bit higher, and we had, well, actually, the unemployment rate actually inched a little lower, but the job creation was not a strong job creation. So we'll find out in the weeks ahead, the next non-farm payrolls report, if this is going to become a trend. As if it happens only once, obviously it's not a trend. But if it's a trend, if it occurs in the upcoming months as well, we continue to see weaker and slower than expected job creation in the U.S., that will be an alarming sign. But the weak non-farm payrolls report here that we saw at the start of this month reduced the expectations that we're starting to get priced in that the Fed is going to start tightening monetary policy sooner rather than later. And obviously that put the dollar under additional pressure. And that will be the implication of paying attention to the U.S. economic data going forward, because if we continue to see signs of weakness, the expectations that the Fed is going to start tightening monetary policy sooner rather than later will be reduced. And so the dollar could continue to suffer if on weak economic data from the United States. But the existing home sales, at least the forecasts, are not expecting to show a lot of weakness. Unfortunately for the Eurozone, however, the Composite Purchasing Managers Index, which is a combination of the manufacturing and services indexes in the euro area, that is due, it's a flash estimate, so it's a preliminary estimate for the month of April, and it is due next Tuesday. Very important event, for me at least, because throughout the last year I have been talking about the contraction in the Eurozone manufacturing and services sectors, and I have used the word chronic. It is chronic, it's been lasting for more than a year. Both the manufacturing and the services indexes have been in contraction territory for, I think, 20 months in a row, or at least 19 out of last 20 months they have been below 50, which is the dividing line between expansion and contraction. And as I said at the start of the webinar today, if the Eurozone Composite Index on Tuesday of next week does not instill any confidence that the Eurozone is recovering, then obviously that increases the odds that the European Central Bank is going to potentially play what I called a QE catch-up with the Fed and with the Bank of Japan. And there were already some discussions, or actually not discussions, but, well, discussions, yes, but the European Central Bank has given the task of putting something together as a proposal by some of the think tanks, economic think tanks and organizations there in the euro area, to put something together as far as a proposal as to how the European Central Bank can stimulate the economy further to help lending to individuals and businesses and so forth and so on, and spur economic growth, which, by the way, in the euro area is still non-existent, unfortunately. And the Composite Purchasing Managers Index on Tuesday is expected to show a reading of 46.3 compared with a previous month's reading of 46.5. So looking at this forecast, it's not very hard to see that there may not be very much of a signal of an improvement in economic activity in the manufacturing and the services sector from the euro area. So both of them are likely to stay in contraction territory, and the chronic contraction simply could continue even further. What does that mean for the euro? Well, I explained that earlier as well. Let's take a look at the daily chart of the euro-dollar pair. The euro has managed to bounce here off of the recent lows, which were, surprise, surprise, around the large quarter point, an important price level in my quarters theory, which is the $1.2750 large quarter point. Two identical lows here were reached about a month or so ago. On March 27th, the low was $1.2749, which is only a pip below $1.2750. And a few days, the next day, $1.2754 was the low. And then a couple of days after that, we saw a low on April the 4th at $1.2743. Now, they may seem all three of them like completely random numbers to some people, but anyone who's familiar with my quarters theory would know that the important price level there was the large quarter point at the $1.2750, which served as the level of support. And so the euro found support at that level, and then it managed to bounce higher. We saw it moving as high as $1.32 level recently. Last week, it reached as high as $1.32, but established a double top with another high the following trading session. It was an identical high within a couple of pips at the $1.3198. And then, of course, we saw a statement earlier this week by, who was it? Jens Weidmann, or was it, what was the other German guy's name there? Who said that the European Central Bank may be cutting rates, which I would not be surprised if they do, and if they cut rates as early as next Thursday after next Thursday, or May 2nd at their meeting. But even if they do not, and so the euro was put under pressure. You can see we had some big down day in the markets, risk aversion, and so forth and so on. So the euro drops a significant amount of pips, which to me it's not shocking because I've been warning that the European Central Bank, whether they like it or not, if economic conditions continue to deteriorate, they will have to do something. They will have to start playing this QE catch-up or maybe even reducing the interest rates. And I've been saying that for like, I think 7-8 months now. As we continuously, month after month after month, continue to see that when we see the GDP reports from the euro area, that growth is non-existent, we get to see these manufacturing and services indexes that continue to show contraction. And so I wouldn't be surprised if the European Central Bank does something. Perhaps even an LTRO number 3. Which, by the way, okay, thank you, Black Cat, for saying that it was Weidmann, I think is pronounced in German. Jens Weidmann says the European Central Bank may reassess interest rates if data changes. Well, today we had on Bloomberg, Weidmann is saying that the European Central Bank would only cut interest rates if data worsens. Which, by the way, I look at the data all the time, and it's not getting better, unfortunately. This week we saw, for example, the ZEW index. Now, the ZEW and the IFO indexes have been the only positive forward-looking indexes that have been showing some signs of improvement in recent months. ZEW has been a little stronger than expected. IFO has been a little bit stronger than expected. Everything else, purchasing managers indexes, retail sales, unemployment, GDP, everything else points to recession. It's just these forward-looking indexes 6 months, in advance or so, that have been showing signs of improvement. But unfortunately for the expectations that the European Central Bank will continue to sit on the sidelines, the German ZEW Economic Sentiment Index earlier this week, on Tuesday, 3 days ago, came up at 36.3. This is for Germany, the only place where there is growth. Not a very strong one either, but at least some sort of growth. The largest economy in the euro area. So it went, this German ZEW Economic Sentiment Index went from 48.5 to 36.3. That's a pretty significant decline. That's what came out this week. And then next week we have the IFO index, which has been also one of these forward-looking indexes of business sentiment, outlook of businesses. That's been a little bit stronger for a few months, but now it's also expected to start showing some signs of a pullback. And so that's why I've been saying all along for many months now that except for these forward-looking indexes, I'm not seeing any kind of other signs that current conditions are improving. And I wouldn't be surprised if there's LTRO number 3, long-term refinancing operations, that sort of quantitative easing to recapitalize banks and stimulate lending in the euro area. LTRO 1 and 2 have already been done. They expanded the European Central Bank's balance sheet to an unprecedented record level, which was, if I'm not mistaken, about 2.7 trillion euros. If they add another trillion of quantitative easing, or at least half a trillion, we're going to see the European Central Bank's balance sheet expanding above 3 trillion euro, which I think that this would be hardly positive for the euro. And so if the market is pricing such expectations that the European Central Bank will either cut rates or consider LTRO number 3 or some other form of easing, then that's not going to be euro positive. So this bounce of the euro that we're seeing here in the last few days and throughout the last couple of weeks might actually be considered as an opportunity for those who view the European Central Bank as more keen to ease monetary policy. If not at the upcoming meeting on May the 2nd, at least by June. And so if the euro continues to encounter resistance at $1.32 or the previous bottom of the range here months ago, if you follow this program, this webinar series, you remember that the euro was stuck here for about a week or so within a range between $1.3250 and $1.34. And the bottom of that range, previous support area, was $1.3250. Again, I'm sure it was a complete coincidence because here's another large quarter point there serving as a level of support and now serving as a level of resistance. But, I mean, who's counting, right? $1.2750 was a coincidence here. $1.3250 is a coincidence there. I'm sure that we can find a lot of other quote-unquote coincidences and completely random numbers there, serving as reliable support to resistance levels. But that's what my quarters theory is all about, is challenging the notion that prices move in a chaotic, unorganized manner. So where's the euro at now? Really, at this point, in a kind of a nowhere zone, to me at least. And the reason for that is because we're neither at close to the bottom of this range, nor close to what may be a stronger resistance area, which, for example, would be previous support around $1.3250, or at least $1.32. At $1.3095, I'm not interested at this particular price level. But if the euro starts moving higher towards $1.32, $1.3250, then one should look for signs of exhaustion, meeting a potential resistance, and if the European data next week disappoints, which I would not be surprised if that is the case. At least the consensus forecasts are pointing to that, that the European data could show more weakness. Then I think that the euro could start being put under pressure once again and ultimately head lower, especially as we start approaching the European Central Bank's announcement on May the 2nd. So, as usual, my perspective is not where the next 10 or 20 pip move is going to happen and when that's going to happen. My perspective is what's going to happen in the next 2 weeks, not in the next 20 minutes. And where is the next at least 200 pips going to come from, not the next 20 pips. So that's my view on the euro at this point. As I said earlier, really not at a level that I'm getting excited about, but you know, if it goes a little higher, that would be better. At least I think we'll watch these resistance levels between $1.32 and $1.3250. If the euro continues to encounter resistance there, don't be surprised if you see the euro being put under pressure again. On the way down, where would the euro go? Well, to another completely random level, just like it did earlier this week. Earlier this week, the euro found support on the 17th of April at $1.30. Now, wait a second. That's not a completely random number, is it? That's actually another large quarter point in my quarters theory. It's just too many coincidences to count. So, $1.30 would probably be the level challenged, and I would not be surprised if the euro breaks it, which I think it probably will break it, if the data disappoints, and if that's coupled with more risk aversion, then that's another factor that could continue to push the euro lower. But expectations, weak economic data, risk aversion, and expectations that the European Central Bank will have no other choice but to ease monetary policy further, those are going to be the three catalysts in the next couple of weeks that could push the euro below the $1.30 level again, and we could see the euro revisiting the $1.20s, 1,000 pip range. We could see another attempt from the market to transition the euro-dollar exchange rate into the $1.20s. Now, moving forward with the top 10 events next week, the second part of the housing data is going to be released from the U.S. on Tuesday morning. That will be the new home sales. New home sales, just as the existing home sales, may be a little bit higher than they were in the previous month. The consensus forecast is for a reading of 420,000 new home sales in a month of March, which would be a little higher than the 411,000 in the previous month. It's nothing really to brag about, but at least if the housing market data continues to be decent, that might alleviate some of the concerns that the U.S. economy is taking a turn for the worse. That's going to take us to the first of the two interest rate announcements next week, and the first one is going to be the Reserve Bank of New Zealand interest rate announcement. The New Zealand dollar started to strengthen in the recent few weeks, and understandably so. I mean, in February, the Reserve Bank of New Zealand governor came out and said that the Kiwi exchange rate should not be considered as a one-way bet, which was a really kind of a hawkish statement that the Reserve Bank of New Zealand may actually intervene. If I'm not mistaken, he even used the word intervention. That intervention, the option of intervention is not off the table when it comes to the New Zealand dollar. But just a few weeks ago, I think, or at least in March, at some point, was it the governor or the assistant governor who came out and said that, well, yeah, the New Zealand dollar is strengthening and we can't do a darn thing about it, even if we intervene? And so that was sort of perceived as a green light to take the Kiwi higher. And I'll show you the daily chart of the Kiwi versus the dollar. This is what it led to. You can see that attempt, there was a bullish breakout that occurred. The Kiwi reached as high as 0.8532, broke above previous significant resistance around, for instance, or not, 0.85 cents, which it happens also to be another large quarter point in my quarters theory, but who's counting? So it broke higher, it reached as high as 0.8532 on the 15th of February, and of course that's when the Reserve Bank of New Zealand governor quickly came out and said that, you know what, we can consider intervening, this is not a one-way bet, consider yourself warned, and so forth and so on. And at that time I said on my program, the All Things Forex broadcast, that we can officially now include the Reserve Bank of New Zealand as another institution that has joined the currency wars. And however, as I said previously, when they said that they can't do anything about it to curb the strength of the New Zealand dollar, even if they intervene, then that opened the door for the Kiwi to strengthen even further, and it broke above 0.8532, reaching as high as 0.8675 on the 11th of April. Of course, ever since then, the Kiwis pulled back a little bit, but I still think that if there is a pullback, then this could be an opportunity. I think that the Kiwi could continue to attract bids, provided, of course, that that's supported, such rally is supported by more positive investor sentiment and risk appetite, which, of course, the Kiwi is not going to be immune from risk aversion as a higher yielding currency. So the Kiwi started to attract some bids here in the recent couple of trading sessions, and if the Reserve Bank of New Zealand sits on the sidelines next week, which I think that they will more than likely keep rates at the 2.5% level. And if they do not issue any kind of verbal intervention type of statements, similar to the statements that were issued in February, that they're considering an intervention, that it's not a one-way bet, the Kiwi exchange rate, and so forth and so on. If that kind of statement is not what we hear next Tuesday at 5 p.m. Eastern Time, it's the announcement by the Reserve Bank of New Zealand. And if next week we see more positive investor sentiment, the Kiwi could continue to attract bids. And it has another difficult task next week is to once again overcome that 85 cents resistance. 0.85 area, as you can see, has been serving as a significant level of resistance. You have a number of resistance levels established here. A little bit below 0.85, 0.8475, 0.84, let me widen this chart so I can get your price points more accurate. 0.85, 459, 0.8479, 0.8532. All of these levels are around 0.85 cents, the large quarter point. So the Kiwi must break decisively above this resistance area in order to continue further, to continue that bullish trend wave sequence that started a few weeks ago. We had a bullish wave number 1, number 2 here. You had a very significant price correction, but it didn't become a reversal trigger wave, as I like to call them. So there's still a chance that the Kiwi could develop another third bullish wave. If it's successful, and the only way it will be successful, Kiwi is the new Cyprus? What kind of question is that? If that third bullish wave is going to be successful, it has to break above the previous high at 0.8675. If it doesn't, then that would be a sign of weakness, to me at least, from the New Zealand dollar, which could lead to further New Zealand dollar weakness. Okay, well, seems like someone's having problems with the sound, but others are saying that it's fine. So anyway, watch for the Kiwi to make an attempt to challenge 85 cents level. If it's successful breaking it, keep an eye on that previous high at 0.8675. If the Kiwi does not break above that level, however, we could quickly see the Kiwi being put under pressure. I would consider that as a sign of weakness, as I said earlier, which could open the door for the Kiwi to drop more significantly if it fails to break above 0.8675. In other words, the Kiwi breaking not only down to 84 cents area, which we saw tested this week, but possibly challenging these previous lows that were below 82 cents, 0.8164 and 0.8161, two identical lows, a double bottom, support being established earlier, in mid-March. But as far as the Reserve Bank of New Zealand's decision, I don't think that they're going to make any changes to their existing monetary policy. That's going to take us to the German Ifo Business Climate Index, which I already mentioned is not expected to be very positive either. Reuters consensus forecast is expecting 106.2 reading in April, compared with the 106.7, which obviously would be lower at 106.2. So another economic report from the Eurozone that may not instill confidence in the recovery there. Implications of that I already explained earlier. On Thursday, the big event of next week, at least for me, the gross domestic product report from the United Kingdom. Now, I have said a lot about this report. I have been anticipating it for 3 months now. It's almost here finally. Why do I get so jittery? Or, not jittery, but so excited about it? It's the reason why I get so excited about it is because that it's finally either going to confirm or deny these expectations that we might see an unprecedented kind of triple-dip recession in the UK. If the United Kingdom's economy contracts in the first quarter of 2013, then it will register 2 consecutive quarters of contraction, which is the definition of a recession, which in the United Kingdom will be a triple-dip recession. The UK economy contracted in the fourth quarter of last year, and if it contracts in the first quarter of 2013, we will have a triple-dip recession. If that is the case, the Bank of England, which has been sitting on the sidelines in recent months, not being in a hurry to ease monetary policy further, to expand the size of their quantitative easing program, not willing to cut interest rates, obviously, they've been waiting. And as I have said months ago, I think that this is the report that they've been waiting for. I've been waiting for it, and I think they've been waiting for it in order to decide how to proceed further with monetary policy. Now, the consensus forecasts are expecting that the United Kingdom's economy is going to avoid a triple-dip recession. The forecast is for very little, but at least a little bit of a growth, not a contraction. 0.1% only. Quarter-over-quarter growth, compared with the minus 0.3 reading in the previous quarter. However, if that number is not plus 0.1, but minus 0.1, or minus 0.23, that will mean a triple-dip recession in the UK. That will mean that the Bank of England could ease monetary policy further. And as our listener says, the pound-dollar pair will be under 150 is his questioning. I would probably say the answer to that question is yes. the pound-dollar pair will be at least at 150, if not under 150. If we get surprising, which to me is not going to be a surprising, it's not going to be a surprise to see the UK economy contracting in the first quarter of 2013. The reports from the UK, although there have been some positives, have not been very strong as far as instilling confidence in at least what the data that I've been watching to say that, hey, the UK is recovering. A listener is saying, is that just a political manipulation to avoid a triple dip? I don't know. I mean, if you want to make the argument that these numbers can be doctored by governments, it's possible. But if there are not any negative quote-unquote surprises, a drop in the UK GDP next week is not going to be a surprise to me, but you know that in the media is going to be the word unexpected is going to be used in the headlines. So if there is quote-unquote unexpected contraction in the United Kingdom's economy with the report next Thursday, then I think that could cause a significant weakness of the British pound. And somebody's asking, what about the pound versus the euro? Same thing. The pound will be weak versus most majors, probably even against the yen, if the GDP disappoints to the downside. But the consensus forecast, again, that's important to note, if the consensus forecast is accurate, the UK could show a very minimal but at least growth of 0.1% quarter over quarter, which will help it dodge the bullet, so to say, and not register on paper a triple dip recession. But don't forget that this is just the preliminary estimate. As with any other GDP report from the UK, it takes 3 months to figure out what the final reading is. This first preliminary estimate is always the one that has the most impact. But it can be revised, either lower or higher. What I'm saying, in other words, is that even if we see a reading of 0.1% growth quarter over quarter, that doesn't mean that the numbers that will, the second revision, which will come in May, that doesn't mean that there may not be a downward revision to show an actual contraction. It doesn't also mean that the number can't be revised even higher. So keep that in mind. But the market's reaction to that report is going to be very interesting to watch, especially if the UK actually contracts. And so what we're seeing now is the pound actually strengthening ahead of this report. It even managed to run as high as $1.5366 in a trading session today. I would watch the highs around $1.54. You had a double top resistance at the $1.54.10, and then the following day $1.54.08, two identical highs. That's a double top into consecutive trading sessions. After which the pound pulled back yesterday to as low as $1.52.14. So far, the pound's finding support a little bit above $1.52 in the area between $1.52 and $1.52.5, the large quarter point. If this area is broken, then obviously that could open the door to a move to $1.50, or at least this support area a little bit ahead of $1.50. You have two lows. They're not very far from each other. $1.50.25 and $1.50.32. A little bit ahead of the $1.50 level. Earlier, there was a question from Ron who said that with the pound dollar yesterday, it followed your quarters theory as it recovered from the low of the $1.5216. It overshot the quarter point by 34 pips. He says, my question is, 34 pips is well within what is accepted as completion of the quarter point at $1.5250. Absolutely, yes. It's a good question. It pertains to the conditions and the requirements that I've created with my quarters theory methodology, that what constitutes a completion of a large quarter. In this case, if prices have been moving back towards $1.5250, it's not really a completion of the quarter. It's actually a retracement of prices back to the preceding large quarter point in the case of the pound-dollar pair, because during that bullish move, the pound moved above the $1.54 level. It overshot above $1.54, but it did not complete the quarter between $1.5250 and the next large quarter point, which is $1.55. So the unsuccessful completion of the quarter between $1.5250 and $1.55 in most instances causes a reversal that takes prices back to the preceding large quarter point, which in this case would be $1.5250. And the pound reached not only $1.5250, but surpassed it by 36 pips below the $1.5250 level. Okay, so I think that the future trend direction for the pound versus the dollar is going to be very dependent on the report next Thursday. If the UK economy avoids recession, that avoids a triple dip recession, that reduces the odds that the Bank of England will do more easing. And then ultimately, we could see the pound strengthening next Thursday. And not only strengthening, but breaking possibly above the $1.54 resistance that is established last week. That's going to complete the quarter to $1.55 very quickly, I think, if the pound manages to break above this level. On the other hand, if the GDP disappoints and we see a triple dip recession, that raises the odds that the Bank of England will do more easing, which is not going to be British pound positive. That could push the pound below the recent support area at the $1.5214, and it could open the door for the pound-dollar pair to move towards $1.50, and if not reaching exactly $1.50, at least challenging these identical lows 25, 30 pips from the major large quarter point at $1.50. That's the major implication of the GDP report next week, next Thursday, 4:30 a.m. Eastern Time from the United Kingdom. That's going to take us to the sequence of Japanese economic data, which is going to keep the yen in the spotlight. Now, the yen, it doesn't sound like for another month the G20 is once again looking the other way. It doesn't look to me that G20 is going to single out Japan as a country and Bank of Japan as a central bank that is competitively devaluing their currency, which is blatantly obvious, but G20 says there's no currency wars, ladies and gentlemen. I have 5 slides in a PowerPoint presentation for a client that says otherwise, and those are 5 slides with statements from central bankers all the way to the French president, to officials, government officials, politicians, central bankers from around the world. And I'm not just talking Japan, not only the U.S., not only the Euro area. I'm talking from around the world. 5 slides, and I stopped at 5 slides because I didn't want to make my presentation boring. I could have literally put together 10 slides at least. But I wanted to drive a point. And the point that I wanted to drive was that no matter what G20 says, that there's no currency wars, that there's no competitive, a race to competitively devalue currencies, the actions and the statements by central bankers, politicians, and other officials say otherwise. And so the G20 doesn't seem like they're singling Japan as devaluing their currency competitively this weekend. I would not be surprised if there is no statement, maybe some generic statement that we promise that we're not going to competitively devalue our currencies, and no mention of Japan's efforts. As I said in my outlook for FXstreet.com that I wrote earlier this week, I said if the G20 gives the green, does not single out Japan and continues to look the other way, which it seems like at least the latest reports are saying that, then I said that could open the door and would give the green light to further yen decline. And we could easily see the 100 yen level next week ahead of the Bank of Japan's meeting. Now, I really don't think that the Bank of Japan is going to do anything more than what they've already done. They already shocked and noticed last month with their unprecedented historic amount of quantitative easing. It even led to Deutsche Bank strategists or economists saying, well, we're all flying blind right now. But there's no currency wars. Nothing to see here, folks. So what I'm saying is that the Japanese central bank is probably going to reassure us, and that's the next, by the way, top 10 event, the Bank of Japan's interest rate announcement later on Thursday night, early Friday morning. They're going to reassure that massive quantitative easing is simply going to continue. That means further yen weakness until this index, the Japanese Consumer Price Index, which is the main measure of inflation preferred by the Bank of Japan, reaches the 2% inflation target by the Bank of Japan. Until that target is reached, the Bank of Japan said, we're going to continue easing. Now, as far as the Japanese Consumer Price Index is concerned, the National Core Consumer Price Index is expected to move further away from the 2% target. Minus 0.4% year-over-year reading, which is further in deflation territory, compared with minus 0.3% year-over-year in the previous month. So the Consumer Price Index could also mean further weakness for the Japanese yen. As the index is not getting close to the 2% level, it's doing the opposite. It's going further away. Well, there's the question, how much Japan can devalue its currency? Any clues? Well, they've already devalued it, almost 20% since last November 2012. They could, the average dollar-yen exchange rate has been, if I'm not mistaken, for the last 20 years or so, has been around 110, 120 yen territory. I think that the dollar-yen could go to 105, 110. I don't see why it couldn't. Maybe even higher. I don't know if it will. If it goes any higher, I don't think that the G20 can continue to look the other way, but at 105, 110, I don't think that that's going to be that big of an issue. As months ago, I said that this time it's different. And what I meant by that is that last year, as a matter of fact, in February, March, we started seeing signs of Japanese yen weakening, but the rally of the dollar versus the yen quickly fizzled because of the developments in Greece and the European debt crisis and so forth and so on. These efforts of the Japanese officials at that time was just an intervention, a couple of stealth interventions, official interventions, a couple of stealth interventions kept the Japanese yen weakening for about a month and a half. But that was it. It was a pop, and then it fizzled. This time, it's different. It's a all-out campaign to weaken the yen with whatever means necessary. Weaken the currency, stimulate the economy, and at the same time spur economic growth, especially export growth, which many of you know Japan is mainly an exporting economy. So a weak currency actually helps Japanese export. And so far, their efforts have been quite successful by the Bank of Japan and the new government there. And they could continue. The yen could continue to weaken. As we're seeing today, the news of the G20 is not going to single Japan out and criticize them of their efforts to weaken the yen are causing the dollar yen to rally once again. It's up about 130 pips in just today's trading session alone. It's been strengthening from the lows earlier this week at 95.77. And, of course, the area to watch here is the 100 yen level because there was a resistance encountered a little bit ahead of the 100 yen area at 99.93. So watch the consumer price index. If it continues to steer further away from the 2% target by the Bank of Japan, that means easing continues and maybe even more easing to achieve that inflation goal, which means even more Japanese yen weakness. And then if the Bank of Japan says, okay, well, we've already done our shock and awe announcement earlier this month, I don't think that they're going to shock and awe again next Thursday night, but they're going to reassure us that they're committed to what they're doing. And they're probably going to say that if the target is not achieved, if this current policy, unprecedented amount of easing, is not successful to achieving their inflation target, then they could do more. And that only opens the door to potential further yen weakness. At least the challenge of the 100 yen level, and probably next week we'll see that area being targeted. We're well on our way to that level. But I wouldn't even be surprised if we see a move above 100 yen next week, provided, of course, that the market's investor sentiment is positive. The U.S. economic data could contribute to positive investor sentiment. As I said earlier, the U.S. data from the housing market, the existing home sales, the new home sales are expected to be positive. The GDP report next week is a big event also from the U.S. Next Friday at 8:30 a.m. Eastern Time. Many of you would recall the U.S. economy. The first estimate for the fourth quarter GDP for 2012 was surprisingly negative. It actually showed the U.S. economy contracting in the fourth quarter. It was revised in the months after that to show the U.S. economy growing by 0.4% quarter over year, which is very minimal amount of growth, but at least it wasn't a contraction in the fourth quarter. The consensus forecasts are expecting the U.S. economy to grow by 3% quarter over year, which is going to be a very significant improvement after a very minimal, insignificant 0.4% growth in the fourth quarter of 2012. That could instill confidence as far as investor sentiment is concerned. And that's why, from the perspective of investor sentiment, positive attitudes, strong risk appetite next week, we could possibly see that if the U.S. data is able to instill that type of sentiment and confidence that the world's largest economy, the U.S., is on the right track. So the existing home sales are expected to be positive. New homes expected to be positive. GDP expected to be stronger in the first quarter than it was in the fourth quarter of 2012. And even the April University of Michigan Consumer Sentiment Index is expected to be positive and better than it was in a preliminary estimate was at 72.3, which was a big drop from the previous month. That reading is expected to be revised higher to 74.3 from 72.3. So the consumer sentiment revised a little bit higher. That would be in line with the potential sequence of upbeat economic data from the U.S. next week. So watch for that, and that consumer sentiment report will be the final of the top 10 events next week. So this is our outlook for next week. I think that you are well prepared for what's coming up in a week ahead. I'd like to invite you to visit my website, allthingsforex.com. Hopefully next week the live trading room will be up and running, so you can check it out for yourself. You can join me on allthingsforex.com or follow us on Twitter at allthingsforex is the account. Thank you very much for joining me today and for listening to this webinar on a regular basis. Have a great day and a great weekend, and I will see you again next Friday.